Liquidity is not just important to financial markets, it is absolutely crucial, and lately there have been troubling signs indicating a decrease in liquidity. One area that is particularly worrisome is the repo market, reminiscent of the events that unfolded in September 2019. Towards the end of November, the overnight repo rate spiked to an abnormally high 5.54%, and it seems to be struggling to return to normal levels. In addition, the secured overnight financing rate, SOFR, hit a record high of 5.39%. These developments are indicative of cracks forming in the foundation of the economy. But why does this concern us? Why is this happening? And what are the implications for individuals like you? Let's travel back in time momentarily to the great financial crisis. Most people are unaware that when Lehman Brothers collapsed, it was due to a liquidity problem. Every night, like any other financial institution, Lehman Brothers would go to the overnight funding markets seeking cash. However, during that period, they were unable to acquire any. Similar to how pawn shops function, overnight banks would acquire collateral from Lehman Brothers, sell it to other banks, and commit to repurchasing the collateral at a later point. Lehman Brothers offered standard collateral, primarily mortgage-backed securities. But suddenly, no one was willing to accept mortgage-backed securities anymore. Consequently, Lehman Brothers became insolvent overnight, as they couldn't secure the cash they required for the following day. Even worse, every financial institution had the same collateral, namely mortgage-backed securities. Consequently, if it weren't for the Federal Reserve's intervention, all financial institutions would have toppled, just as Lehman Brothers did. The Federal Reserve stepped in and injected the necessary cash while taking on the bad collateral. This ensured that every institution had the cash they needed to operate. Therefore, when you witness a rapid and unexpected rise in the cost of overnight cash, it serves as a reminder of the problem that occurred during the financial crisis. This is precisely why it is problematic. Not a single financial institution can survive without easy and affordable access to overnight cash. As the reserves within the financial system dwindle, the accessibility of liquidity becomes scarcer and more expensive by the day. So why are we observing a recurrence of these issues now? There are two primary reasons. Firstly, the Federal Reserve is employing the same strategy it used during the previous episode of problems in the overnight funding markets. This strategy is known as quantitative tightening, QT. Quantitative tightening is the polar opposite of quantitative easing, QE, a term that most people are familiar with. QE involves the Federal Reserve printing money and purchasing assets, often U.S. Treasuries, from financial markets. However, QT involves the Federal Reserve reducing its holdings of these assets, thereby draining liquidity from the system. To understand this phenomenon, we must delve into the workings of the Federal Reserve's purchase of treasuries from the open market. When the Fed buys treasuries, the selling banks receive cash in return. This cash empowers the banks to utilize it in any desired manner, often reinvesting it in further treasuries. Consequently, this process augments both the overall money supply and the level of liquidity in the system. Moreover, it elevates the liquidity to collateral ratio since the Fed injects dollars into the system while withdrawing treasuries as assets or collateral. More reserves, more liquidity, and increased cash are observed while simultaneously experiencing a decrease in collateral and assets, specifically treasuries. However, it is crucial to note a nuance for those inclined towards technicalities. Quantitative easing, despite its impact, does not directly regulate or control the actual money supply known as M2, encompassing bank deposits such as dollars found in personal bank accounts. Instead, it bolsters the foundational layer of money, also known as bank reserves. These increased bank reserves grant the banks the ability to create loans, ultimately inflating M2, encompassing the dollars residing in bank accounts like personal deposits. Recognizing this nuance is significant, especially considering the quantitative easing measures implemented after the financial crisis, as they did not result in a substantial surge in the actual money supply. On the contrary, the quantitative easing adopted in 2020 and 2021 undeniably had a massive impact on the actual money supply. Therefore, quantitative easing lays the groundwork for expanded circulation of money without directly causing it. Modern investors encounter an array of new and unique risks. Investing in stocks poses the risk of a market crash, while investing in bonds may cause bond values to plummet due to rising interest rates. Keeping money in cash exposes it to the erosion of purchasing power through inflation. Investing in cryptocurrencies comes with the threat of fraud, exemplified by cases like Sam Bankering Free. Consequently, many investors seek alternative stores of value, such as gold and Bitcoin. Unfortunately, accessing these assets proves challenging for most investors, who primarily hold their assets within their retirement accounts. Regrettably, most retirement accounts do not permit investments in gold, silver, or Bitcoin. One organization that maintains a strong reputation for its trustworthy practices is I Trust Capital. Their approach to asset management ensures that clients maintain ownership of their assets as they are held off balance sheet and kept separate from the company's own accounts. To ensure the safety of these assets, I Trust Capital partners with industry leaders like Kitco for precious metals. By emphasizing the separation and security of their clients' assets, I Trust Capital offers transparency and peace of mind. As an added incentive, using the link provided in the video description will grant new users $100 worth of Bitcoin upon signing up. Now let's shift our focus to quantitative tightening, QT, the complete opposite of quantitative easing, QE. Quantitative tightening refers to the process by which the Federal Reserve's balance sheet decreases. To better understand this concept, let's examine the Federal Reserve's balance sheet over the years. In 2008, it experienced an increase, followed by further increases in 2011, 2012, 2013, 2014, 2020, and 2021, all due to rounds of QE. In contrast, the first round of quantitative tightening occurred from 2018 to 2019, and a subsequent round took place from 2022 to 2023. If the Federal Reserve's growing balance sheet during QE increases liquidity in the financial system, then it logically follows that a shrinking balance sheet during QT would decrease liquidity. The mechanics of these two processes are essentially opposites. During QE, the Federal Reserve prints money and purchases assets, effectively removing assets from the financial marketplace while injecting cash. On the other hand, during QT, the debt purchased by the Federal Reserve is paid off, resulting in dollars being paid back to the Federal Reserve and ceasing to be in circulation. It is worth noting that the Federal Reserve can actively engage in quantitative tightening by selling debt back onto the marketplace, further reducing the amount of circulating dollars and making liquidity scarcer. This reduction in liquidity is observable both in absolute terms and in relation to the amount of assets or collateral in the system. The impacts of quantitative tightening became evident in September 2019, when financial markets were abruptly hit with a liquidity crisis. During the period from 2018 to 2019, as the Federal Reserve engaged in quantitative tightening, liquidity in the financial system became increasingly scarce. The implications of this scarcity were felt when suddenly there was a widespread need for cash, but it was not readily available. The overnight funding markets, particularly the repo market, experienced significant disruption and increased costs. Consequently, the Federal Reserve had to intervene once again to restore stability. Their approach involved a return to quantitative easing, as evidenced by the rise in their balance sheet. Unlike before, they injected fresh cash into the system by purchasing assets out of circulation. It is essential to note that while the Federal Reserve plays a crucial role in this scenario, there is another reason behind the current situation, namely government borrowing. Let's look back at 2018 and 2019. In the chart depicting the federal surplus or deficit, the blue line represents a surplus, indicating that the government is collecting more tax dollars than it is spending. However, for much of the United States government's history, the blue line has remained below the black line, signifying that they spend more than their tax revenue. To bridge this shortfall, the government resorts to borrowing, which contributes to the national debt. This annual shortfall is known as the deficit. Interestingly, many people, particularly those on the political right, may not be aware that President Trump actually exacerbated the deficit. The trend shows a continual worsening of the deficit since Obama left office, culminating in the deficit surpassing $1 trillion in 2019, the highest since 2012, even before considering the additional spending caused by the COVID-19 pandemic. It is crucial to acknowledge that as the Federal Reserve engaged in quantitative tightening, reducing liquidity, the federal government's borrowing increased significantly. When the government borrows money, it does so by selling treasury bonds, also known as treasuries. These bonds function as IOUs, promising to repay a specific amount of dollars on a predetermined date, with interest added. Investors purchase these bonds by exchanging dollars, which the government can then utilize for various purposes. When the government's borrowing intensifies, leading to a worsening deficit, an increased number of these IOUs flood the financial system. Consequently, when such borrowing coincides with the Federal Reserve tightening liquidity, a liquidity crunch occurs. There is a shortage of dollars in circulation despite an escalating demand. This is precisely what transpired in 2018 and 2019, and it is recurring today. Examining the Federal Reserve's balance sheet since May 2022, it becomes evident that it has been declining. Despite the improvements in the federal deficit following 2020, the deficit began worsening again in 2023, reaching an astonishing $1.7 trillion. When we consider the cumulative effect of increased government borrowing and the Federal Reserve's quantitative tightening, we can observe that these two factors are occurring at an unprecedented pace. Whenever these occurrences overlap, the market's response is typically adverse. For instance, the taper tantrum that took place in late 2018 resulted in a stock market decline of over 20%. One potential solution to avoid such issues in the future is the introduction of a central bank digital currency, CBDC. If all money were stored on a unified ledger controlled by the central bank, overnight funding cash markets would become obsolete. Each individual's funds would be a ledger entry at the central bank, removing the need for liability at private banks. All transactions would be recorded internally, much like adjusting numbers in a spreadsheet. This approach would eliminate the concerns associated with overnight cash markets, matching assets and liabilities, collateral complications, and settlement issues between banks. However, it is essential to clarify that I am not advocating for a CBDC. In fact, I vehemently oppose the idea. CBDCs can serve as an oppressive tool for tyrannical regimes. By exposing their plan, it becomes evident that if another catastrophic event occurs in the overnight funding markets, a CBDC will likely be proposed as a solution. Unfortunately, while it may address immediate issues, it will come at a great cost to freedom, prosperity, privacy, and individual financial sovereignty. Thank you for watching, and I hope you have a great day.